Capital gains is the money you earn from holding an investment and waiting for it to go up in value. When you sell this investment, the government will deem this profit as income and it will be taxed as such. However, they can be lenient, which I will get into later in this video. For a bit of background information, the word capital in finance is referring to something that holds value. And when looking at the gains or losses, you are looking at its change in value. So let's say you bought a property for $350,000, and then either when you went to sell it or when you were just getting the property revalued, you found out that it was worth $420,000. The capital change would be the difference between these two values, which is positive $70,000 in this case, making it capital gains. Capital gains or losses is not only referring to property, it's just talking about something's change in value between when you bought it and now. So, there is a tax called the capital gains tax, but it isn't quite as simple as just calculating how much profit you made and then paying a certain percentage on that amount. The moment you sell an investment is when its change in value has to be declared to the government. This means that you can hold a share that is worth 3 times as much as you bought it for as long as you want without having to pay a cent. Once you do sell it, however, you have to add the difference between the purchase price and the selling price to your taxable income. This is assuming that you made a profit in the first place. And thankfully, the government can't tax you on any of the knowledge that you gain from my videos. Your taxable income is a sum of all of the income that you've made over a financial year, whether that's direct payments from your job, dividends from a share, income from an investment property, or any other form of passive income for that matter. You then get to deduct from this sum any donations that you've made, the total sum of money that you've had to spend on necessary objects for your job, whether that's clothes or electronics or anything else. A full list of these deductions will be shown on screen now. And after you've figured out this sum, you can then figure out your tax by cross-referencing it with the tax table and your tax bracket within it, which is a group of a taxable income range, which gives you how much you need to pay for your tax. So, once you sell an asset that has gone up in value, you would then have to add this difference in value to your taxable income, which would then make you have to pay more tax once you calculate how much you have to pay using the table. This area of taxation also includes capital losses, which is where you sell something for less than you bought it for. And there's also a list of things that this doesn't apply to, such as cars, because they have a widespread condition of losing value over time. What you do in the case of capital losses is that you get to deduct it from your next instance of capital gains. This could be in the same financial year or not. This means that the capital loss will sit against your name until you next are able to use it against a capital gain, except you do have to use it at the first chance that you get. So this means that if you lost $2,000 on a stock investment, you get to subtract this from your next instance of capital gains, which would have otherwise had to be added onto your taxable income. There are 2 main exceptions to this tax, which you can use to help keep as much of your money in your pocket as you can, without letting the government take it away from you. The first exception is that if you've held an investment for more than 12 months, you get to halve the amount that is added to your taxable income. This means that if you've held an investment property for over 12 months and you sell it for $130,000, you only have to add $65,000 to your taxable income. The annoying side effect is for capital losses. You have to add them before you halve the gain in total, which means that the losses also get halved. The second exception is that you don't have to pay this tax on your PPR, your principal place of residence, your home. This is regulated though. The government wants to make sure that you've lived there over the last 6 years. So that means that you can be renting somewhere else for up to 6 years, but after that you would have to again pay this capital gains tax when you sell the property. This timer will be voided if you purchase another property with the intent of it becoming your PPR. So if you're purchasing a new place to become your home, make sure you sell your current house before that happens, or else you might have to pay a hefty fee. That's all for me today. I've been Tom, and I'm signing off on another Tom's Funny Magic video. See ya!